Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing, and we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show.
Welcome, everybody, to another episode of the Tech Guys Who Invest podcast, where each week you learn how to invest wisely and safely. This episode is a favorite episode of mine. This conversation was fantastic. I'm excited to bring it to you. We're excited to bring it to you, but I'm more excited because we are talking with a note investor about how you can do good deeds, which is also a play on words, through note investing. We're going to learn what cool stories our guest has to share with regards to being able to help borrowers stay in their home while being able to make a return for his investors. So let's learn about our guest. Chris Seveney is a real estate professional with more than 20 years of experience and has developed over $750 million worth of real estate. Through his education and experience, Chris has been able to build his note investing portfolio to over $3 million and his overall real estate portfolio to over $5 million. As the son of a lifelong educator, Chris now shares his knowledge of first position performing and non-performing notes to his peers with his Good Deeds Note Investing podcast and webinars. Along with investing in first position performing and non-performing mortgage notes, Chris enjoys his full-time job as a director of construction for a Washington, D.C. based development firm who is an industry leader in sustainable design and construction. In his free time, Chris enjoys spending time with his family and is an avid Boston sports fan, having spent much of his life living in Massachusetts. So without further ado, let's learn about how you can do good deeds through note investing with Christopher Seveney. Welcome, everybody, to another episode of the Tech Guys Who Invest podcast. Today, we have Chris Seveney from Seveney Investments and also the co-host of the Good Deeds Note Investing podcast to talk about, well, notes. So welcome, Chris.
Thanks, Kevin, for having me, and Adam as well.
Yeah, thanks so much for coming on the show. Chris, let's jump right into it. Can you talk to us a little bit about the most common reasons people get into note investing?
Yeah, I'd say the most common reason I see people get into note investing is it's a little obscure. It's a little niche market. So people hear about it and like, ooh, what is that? And it's kind of unique. So people, anytime something is, not ordinary or unique, people want to kind of test it out and look to get into something. Because it is a form of real estate investing, which a lot of people enjoy getting into because I think there's a sense of almost power owning real estate. And note investing is kind of almost that power squared because you become the bank, and you're not only owning the real estate, you're controlling it, which people like to see. So from that perspective, and that is one. The other is really from the passive side of things. Sometimes people think it's a very passive industry. And people get tired of being a landlord or tenant and are looking for alternative ways to invest secured by real estate. So note investing is actually very good for that, where unlike stocks, which go up or down and you have no control over, you own a note or the loan on an asset that is secured by the real estate. So there's some backing there behind you.
I love it. That whole aspect of being secured by real estate is huge. When it comes to note investing, what would you say are the most common ways people get into note investing?
By accident. No. So, I mean, I say it jokingly, but no, it's, owner financing, seller financing. Most people, will try, may have a property and they have somebody on the hook and they can't afford it or they can't get the full down payment. So people may, give a portion of the loan. From that perspective. Others, hard money lending is a form of note investing. So those are, several ways people get into it. Like I said, it's not highly advertised. Like,
right.
You drive down the street and all you see is we buy houses from wholesalers and everything else. I mean, you can't not find those signs. It's almost like an election year. We're seeing those signs. Note investing is, a small niche industry. So unless it exists, which I've been in real estate for over 20 years, didn't know it existed. Typically, you kind of fall into it by accident.
Chris, what is it that is so appealing about it to you? Obviously, you've chosen to focus on that, and I'm just curious what it is that you like so much about note investing.
For me, it's the flexibility and diversity. And what I mean by that is I'm in the Washington, D.C. area. It's a highly competitive, very expensive market. If a property comes on the market on the MLS, you're never going to get it or be able to do anything for an investment property typically with that. Even the off-market properties, there's so many people and investors in this area. It's very difficult to find the deals. And knowing real estate the way I do from my background, trying to own real estate and renovate from afar is very challenging and difficult. So note investing kind of is perfect for me because I work a 9 to 5 job, and I can do note investing anytime during the day. I review the assets and the tapes at 10, 11 o'clock at night, put my bids in. In the morning, I can send out emails to attorneys or servicers or whatnot, wait for them to get back to me during the day or that evening. So it is something that truly is, even pre-COVID, can be done working from home, working from anywhere in the country or anywhere in the world at any time during the day.
Love it. And that's why I'm part of it too. And that's one of the reasons I enjoy it is you can do it from all you need really is a phone and some internet connection and off you go.
Yep, exactly.
When it comes to notes, what would you say are the advantages that note investing has that investors tend to overlook?
I think several are the number of exit strategies. Most people don't understand, the higher you are on the food chain of any, in any type of business or product, the more exit strategies you have. And in note investing, if you're dealing with a distressed asset, you can, try and work out something with the borrower. You can, unfortunately, you may foreclose on the borrower. You can offer the borrower cash for keys. You can offer the borrower a short sale to, liquidate the property. And that's, I'm just rattling off a few. And then,
right.
You can take the property back, rehab it, and then owner finance it or sell it. There's so many different options for you that you have that gives a lot of advantages to that standpoint. And what most people you'll hear about when you hear note investing is, a lot of times you're not dealing with the tenants' toilets or termites. If you own a house and your roof leaks, do you call your lender to fix the roof? No.
Never.
Yeah.
No.
So from that asset, from that perspective, you control the asset, but you're not responsible for, the upkeep and the maintenance of it.
So when it comes to exits, what would you say is your favorite one?
My favorite, well, we always try and work something out with the borrower and try and do some workouts that, I'll talk about some of those later on, some of the interesting and creative things we've done. And that's the other thing too. It's an advantage. You can be very creative. You can defer payments, you can lower payments for a period of time while somebody goes through some type of challenge. So there's just so much flexibility that you have is one of, again, those advantages. And for me, it's, trying to keep the people in their property is what we try and strive for.
Yeah, that's nice. I know Kevin talks about that as being one of his favorite reasons for investing in notes. And I really love that aspect of it, just being able to help people out, which truly makes it a win-win, right? Because you're benefiting while you're helping someone else. I think that's really cool. What about some disadvantages of note investing? What are some disadvantages that investors might overlook?
I think one of the biggest ones is risk. And people think that there's less risk because you're the lender. That's not the case. When you're buying these notes, especially the ones that are distressed, you need to try and get an accurate appraisal on the property, but you don't get to go inside the property. So you're literally going based off of somebody driving by the property or, getting some eyes on the property, but it's very inaccurate. So that just leads to greater risk because of that price. You may think a property is worth 100,000, lo and behold, it's only worth 30. That's a big change. And especially as you're pricing an asset at 100,000, hey, maybe you paid 55, 60,000 for it. If it's only worth 30, And then after you sell it and everything, it can be some significant losses. So I think that's one of the areas. The other disadvantage is it's not buying one-offs, is even, I'll say includes it is a greater risk. It's, if you think of investing in a portfolio of stocks, if you buy one stock, you're in much greater risk. Whereas if you buy 10 different stocks that are kind of non-correlated, just similar to like notes, you get greater diversity. So a lot of people, as they get started in this business, don't have the capital or the funds, nor the experience where they want to go out and buy 10 notes, because you want to kind of work out, oh, my first one, am I doing it right? You don't want to make that mistake times 10. So that's one of the disadvantages. And the third is, it's I'll say the education component to it. There's colleges and stuff you can learn about, other aspects of development and real estate or construction and get degrees. And it's, really roll up your sleeves. In note investing, there's some financial component, but on the non-performing side, the stress that side, there's truly no, structured, education system in place for it. You got a lot of gurus out there who will, try and teach you it for, obscenely expensive numbers, but it's really a, business where you kind of got to roll up your sleeves and get involved and do it.
That's great. On the first point you mentioned there with, not really being able to get inside the house and do as thorough due diligence as you might be able to with some, other types of investing. What do you do to kind of mitigate against that?
Use conservative numbers is one. I try and stay away from vacant properties because vacant properties are much higher risk. If someone's living in a property, is it safe to assume that it's in livable condition? Well, you'd like to think that, but there are instances where it's not.
Yeah.
From that perspective. Now, there's some creative things I've seen people do in the past, like, deliver a pizza to the house. And, basically people are like, I didn't order pizza. And it's like, oh, sorry, and, open the door and might be able to get a glimpse of what the inside looks like, as an example. Or, unfortunately now I'll say again, with everything, in the pandemic we're in, you don't see a lot of that. But prior to that, or somebody, go to the door, try and, sell somebody on a magazine or something, whatever it may be, just to try and get some eyes inside the property from that perspective. But, the biggest thing is you just got to be conservative. And one of the things I'll mention for people, one of the things a lot of people order is what's called a BPO, which is a broker price opinion. A lot of people will just get that from a realtor and just look at the numbers and say, oh, they say it's worth this much. It's everything in this business you have to analyze to the nth degree. And when you get one of those BPOs, you got to analyze, were they comparing it to what type of properties? Because if you get a property back, it's going to be considered a REO, or real estate owned, which those values are typically less. You don't want your comps being 3 houses that just had complete brand new renovations of kitchens, baths, and floors, because chances are if you have to take a property back, it's not going to have new kitchens, baths, or floors in it. You're lucky if it has a kitchen, a bath, and a floor in it, never mind a new one.
Good point. So, Chris, you're the co-host or the host of the Good Deeds Note Investing podcast. For anybody that's listening, highly recommend that you check it out, because Chris talks about the day in the life, the trenches perspective of being a note investor. The idea of the podcast, as I understand it, is you're talking about all the good deeds that you do as a note investor. And you mentioned working with the borrower. So now, what would you say are some examples of those good deeds that you've done? And we'd love to hear some stories about that.
Yeah. So one has been a property in Arizona where the borrower's wife had passed away, and he didn't have any family, was struggling to afford the property, and the payoff on the property was more than what the property was worth. So it was upside down. He really couldn't afford anything else. He was a military vet as well. So what we did was, I worked out directly with him, which was essentially he signed a deed in lieu to the property to give the property back to us, in exchange for I think it's a 20-year, I don't even know the term, but a 20-year lease, that he leases the property back during that time, for $1 a year plus the cost of the taxes, property taxes. So basically, he, because really couldn't sell the property. He had no place to go. It was upside down and so forth. So it was one of those things where, work something out where, I now own, a piece of property in Arizona, that, basically I rent it for $1, a year, believe it or not. But it was a win-win for both, because again, he wasn't going to be able to afford the property, so he wasn't going to make the payments, and then to try and turn around and sell it and so forth, would have been a struggle, and I would have had to, clean up the property, get him out and stuff, and it was just, not something I was interested in doing. So, that's one of the things we worked out. Another that I'll say is there was a borrower who filed Chapter 7 bankruptcy, which in Chapter 7, you liquidate all your debt. So you're no longer responsible to pay those bills. They're completely worked out. But on a mortgage, you don't get the house for free. And sometimes, especially, people who may be elderly or whatnot, sometimes get a little confused and, basically, they don't pay, and you buy a loan where somebody hasn't paid in a few years and had a Chapter 7, and they were just confused that they didn't think they had to pay anymore, which is actually true. But if they want to keep the house, they have to. So we're working out between my attorney, her attorney, and everyone trying to work out a new plan right now to keep them in the property, and restructure a plan, and basically take a lot of the past due and arrearages and, maybe getting rid of those or taking them to the end or whatnot, to try and keep this person in the property. So that's another example. I honestly could sit here for hours and tell you other stories of things we did, with people. Kevin, I think there was the asset that I sold you where the neighbor, actually, it was a property we took back, and the neighbor, went and bought the property because he was renting from a family member who was basically charging him a ridiculous amount of money and not fixing the place. So this guy wanted a place of his own. So he got a pretty good deal on a property that he went in, fixed up, and I sold you the note, and hopefully Double D is still cutting you checks. So,
yes, he is.
see, there you go.
Nice.
So, and that's that's a win-win, right there.
Absolutely a win-win for everybody involved.
Yeah.
Chris, I have a quick follow-up to the first one you mentioned, the Arizona one. It's interesting. I'm not sure if I quite followed, though, how you were making money on that one. And for anyone else who's listening who maybe also wasn't tracking there, can you tell us about how you made money on that, or what your strategy was there for that thing, and how that person paying you $1 a year just factored into all that?
To be honest, I'm not making any money on it right now.
Okay.
And the reason why is, the asset, let's just use some round numbers. The borrower owed $30,000. The property's worth, call it $30,000. It's combined, it's over 10 acres of land, down in Arizona, in an area that, who knows what, I'm guessing, people probably eventually continue to flock to Arizona. Who knows? My acquisition price on this was, significantly lower than what the balance was. So essentially, I'm sitting on a piece of property that I own right now, that had a lower acquisition cost. That, am I making any money right now? No, but I'm just banking on, some appreciation down the line, or even if it doesn't depreciate, I'll still end up, probably doing pretty well with that asset. So
Gotcha.
But yeah, right now, that's the one thing that I'll mention too. And I was at a conference and someone mentioned something like, if a borrower wanted a modification, and everyone targets a certain double-digit returns or whatnot, but if you get a borrower who really can make some type of payment plan together, and instead of making 15%, you're only going to make 9%. Do you make that you make that deal with that borrower to try and keep them in their home and the social impact are good. Do you do that? And different people look at it different perspective. For me, yeah, I would, because if you look at it, say it was a $30,000 deal, 15% is what, 4,500, 9% is what, 2,700, $1,800 to keep someone in, would you throw somebody out of their house for $1,800? You think of it that way, and change, and think of the impact that has on somebody. So, that's where the whole good deeds came through. With the podcast is we want to try and do good. Now we can only do as much as the people on the other end want to play ball with us. If people aren't returning phone calls, people are ignoring us, people, basically, just, say they'll do something, can't fulfill their obligation, comes a point in time where you can't work with them anymore. And sometimes you have to go that, take other actions. But for the most part, like I said, if people want to play ball with us, we'll play ball.
Very cool.
Absolutely. You can only help people that are willing to help, or willing to take the help and willing to work with you.
Yeah.
When you forgive debt, how does that work? Can the lender just say, "Oh, you have 50,000. I'm just going to say, you know what? Forget it. I'm feeling charitable," or what would be, from your experience, how do you handle something like that?
Typically, you got to be careful, because I think anything over $600 is considered a taxable event for that borrower. So typically what you will want to do is add it to the end of the loan. And then at that point in time, somewhere down the line, keep deferring it or do something almost so it doesn't become due. Because if you take 50,000 and say, "Hey, I'm cutting 50,000 off your mortgage today," the servicer by law has to, basically, give 1099 them for that.
To the borrower who's already having trouble. So they're like, well, I have to pay taxes on this. What am I? There's no way. Yeah.
Now that is on the flip side of things. That's a whole nother animal where if you have a borrower who's in distress, and they're not playing ball with you and they owe like $100,000 on a $20,000 home, you can 1099 them for, write off like $80,000 and then sell for 20, and all of a sudden they get an $80,000 tax bill.
Wow.
I've seen people do it. Yeah. I've seen people do it. I have not done that, to this point in time, but, there's probably been some borrowers who, get you upset where you'd want to do that to them. But, and you have the right to. I mean, you're not breaking any laws by doing anything like that. So, it's basically, options that you do have.
Sure. I love
Chris,
it.
Go
ahead, Adam.
Kevin. All right. I was gonna follow up, Chris, and just kind of ask how COVID-19 has impacted you as an investor, of course.
It's not as dramatic, I'd say, as other businesses. From example, like, being I'll stick real estate, being a landlord. A lot of people have issues in collecting rent and evictions and so forth. I've seen some people, ask for a month or two forbearance on things. I haven't seen massive amounts of borrowers coming back asking for forbearance plans or stop payments. My delinquency rates pretty much over the years, it hasn't changed significant. It's a little higher this time of year compared to other years. Typically this time of year usually does get a little higher in January because of people spending more for the holiday season. And then a lot of people catch back up in, call it March and April when they get their tax money back. From that perspective, where I've seen the biggest change is timing on loans that are illegal, because courts are shut down, courts are slower. Certain states you can't proceed with legal action. For example, Wayne County, Michigan, which is where Detroit is, they've basically been shut down forever. So, anything in there, you can file it, but then basically it just keeps getting continued, and then you just keep paying $40 to continue it every 2 weeks. And it's like, why bother filing anything? So from that perspective, so with foreclosures taking longer, your pricing of assets has to change, on the non-performing debt, because time is money. So if it's going to take longer to exit that asset. You have to just, bid strategically to make sure your costs accommodates a longer period of time.
Okay. Now, with COVID-19 and things like moratoriums and stuff like that happening, how do you see the market shifting the next 6 to 18 months?
That's a great question. And, we all take out our crystal balls to try and see. And, for most real estate investors, I think the biggest impact, on your business is, how you proceed and the things you do. The external forces outside of the 2008 crash, from that perspective, what we see right now, inventory is very low, so pricing's high. Once the dust settles, will inventory get back to normal and prices settle down a little bit? Probably. Where are we going to be with all these forbearances? Nobody knows what the government's going to force people to do. Now, the loans we own are not government-sponsored entity Fannie loans, but
Right.
a lot of states may still push for these privately held loans, which are about 45% of the loans out there, to kind of follow some type of suit. I don't foresee a massive, all of a sudden wave of non-performing debt hitting the market. I think a decade ago, when it did occur, banks were over leveraged and didn't have a lot of cash in hand. And banks, the way the banking system works, we could talk hours, but banks need to have some money in reserves, which they have now, so they can take care of some of this debt. Plus, the way I'd say the social economics of this country has changed over the past decade. A decade ago, I think banks were just like foreclose, foreclose, foreclose. Nowadays, I think mindset is work with the borrower, let's try and get a forbearance, because a lot of people believe that the impact is going to be, short in terms of, 12, 18 months after the fact, economy gets back up and rolling again, people get their jobs back and then start paying the mortgage again. So, it's tough to tell, but I don't see any drastic shifts in either direction, especially for people like myself who we're kind of on the lower end of the totem pole for investing. Right. We're not buying directly from the banks anyway, so it's going to work its way several ways down to us.
Somewhat related to that, with the Fed pumping so much money in right now, and with inflation starting to rear its head, how does that kind of factor into your strategy and what you're looking to do over the short term?
Well, inflation typically raises home prices, which is a good thing for a note investor, for two reasons. So there's two things really right now, or three things. If you could pick an ideal economy, you'd want low inflation, low interest rates, and basically, basically a stable kind of stock market, type thing, which kind of we have right now. So it's kind of ideal. Now, if inflation starts going up, interest rates will probably rise. And for note investor, that might be a good thing, because people, may try and refinance. And on your performing debt, if you get people refinancing, you get paid off. So that's been a benefit in the past 6 months, with interest rates being very, very low. I've had people who had loans at 6-7% that I hold, refinancing and paying me off because they're getting 3% and they qualify. So that's been a huge bonus on these low interest rates. Now, some borrowers who are, not great payers still want a 3% loan like the rest of us. Unfortunately, we can't accommodate them for that. But, we try and work with them to get them to refinance, because if we can get them to refinance and lower their payment and have another lender come in and pay us off, again, it's a win-win for everyone.
Huge win-win.
Yeah.
So when it comes to somebody with a 9-to-5 or W-2, like the three of us on this episode, and they want to start investing in notes, let's say in 2021, as we're rounding the corner, as we're recording this at the end of December of 2020, what would you say to them if they wanted to start?
Educate yourself. Start, the best way is to, I'm not the type of guy who reads, a lot of books. I'm kind of a learn by doer. I read a lot of articles. I know, there's books out there that have been written by, Alex Godofsky, Bulletproof Due Diligence, and, Paper Profits, and a bunch of note investing specific books. But for people, those give kind of an overview. I've got a friend right now who I went to college with. He's a brainiac. He's a PhD in chemical engineering. So, it's, yeah. And he wants to get into notes, and he owns some real estate. And the way he's doing it is he's mapping it out. He has an end in mind. I want to buy a note by this date. How do I learn? What do I need to do? And I just keep spoon feeding him things to go look at and learn. For people who want to get in this, you have to realize this isn't something that you can go take a course over a weekend and just hop in and start buying notes.
Right.
You go to some of these seminars and they get you all pumped up. I tell people it's like when you're back in college and you're drinking with the girls drink with the girls, or guys drink with their buddies. It's like, we're going to go do this next week, and this is all these plans we're going to have. And, 2 days later, after the hangover wears off, you realize like, wow, that was a pretty dumb idea, and that's never going to happen. It's kind of sense with note investing in a way, because you take these weekend courses, they make it sound, and again, it's not just note investing. I've seen it with stock options and all this other things, where you go for the weekend, they make it sound so easy, but they confuse the hell out of you to get you to keep moving, and then buy more courses or whatnot. So I just think just educate yourself, and some of the places, your podcast, my podcast, Bigger Pockets website. I've got a Facebook group off the podcast. Just try and divulge. And if you want to get involved, when you ask a question, be specific. Just don't say, how do I do note investing? Say, hey, I was looking into note investing and I read this thing about X, and I was curious why it's important, or something along those lines. Then people will treat you with a lot more respect. And answer your question. You say, hey, I want to get note investing. What is it? People will be like, there's this search engine called Google. It's been around for a few days. And if you do, it will give you a few million results on it. So maybe start there. And that's one of the things where you can usually tell pretty quickly people who really want to be in it, or people just kind of window shopping about note investing, just to kind of see what it is, or see if somebody will just kind of basically do it for them.
Yeah, that's awesome. For our listeners, that's really good advice Chris just gave there about how to approach someone who's maybe a veteran in any type of niche that you're trying to look into. If you go to someone like Chris and approach him the way he just mentioned, where you seem educated, you're motivated, you've been proactive, and he's going to be much more receptive to help you out than someone that just comes in like they don't know what they're doing.
Here's a perfect
What's
example.
A note?
Yeah. Well, here's a perfect example. I had a guy who I did a call with him about a week ago, and he's very new to note investing. And he's like, hey, I was looking at this note, and he had some real estate background, and it was on the website PaperStack, which is an online portal where you can buy. And it was a second lien, and there was statute of limitations issue with it, meaning that after a certain period of time, it's not collectible. He went and did all this state research on like the statute of limitations. And then we were talking later about, well, how do I differentiate myself, and how do you kind of grow? I said, well, you've already done it. He goes, what do you mean? I said, just become an expert in one thing, one little thing. And, at first, if you're the go-to guy, somebody has a question on something in a specific state, people will go to you. And then, at first, yes, you technically are pigeonholed into, that one state, but then you learn the second state, the third state, and then you self-improve in that process. But I said, by just being an expert in one little area, when people think of, due diligence, they think of, okay, pro Alex Godofsky, pro title. Or if you want to think of something, someone else, it's, who knows if he knows how to bid on assets. He's known for that, and he's, that's what his company does. So, for people wanting to, get in and be a niche and not just be a number with the other thousands of investors, got to be a little different and, become an expert. And then just like I said, on Bigger Pockets or these Facebook groups, post something you learned, and from that perspective. And then some people are like, wow, this is pretty good. And then all of a sudden trust me, it doesn't take long. 2 years ago, I started my podcast. I was a nobody. I still think I am, but for some reason, I get people who, listen to me. But I mean, I was just some guy who had bought some notes and just wanted to tell my story. And, now that I provide, I tell the story and I tell it like it is, and I share the education that I've learned and some of the details, you get people who respect you.
That's just more really great advice. Thanks for sharing that. I think it's fantastic advice, especially finding something to be an expert at. It doesn't just apply to note investing. It definitely applies to multifamily where I'm playing. And I know for a fact it applies in other investor identities as well. So thank you for that solid advice. Chris, I wanted to ask you if there's a podcast or other information source that you regularly listen to. I know you mentioned a few earlier, like Bigger Pockets and our podcast and your podcast for people who are getting started. But is there one that you like?
Well, yes, but it's been a little challenging because this past year I was finishing getting a master's degree. So I was in grad school. So, working 9 to 5, I have 2 kids, the wife, and, get a master's. But I'll be honest, I don't watch much TV unless it's a sporting event. The TV is pretty much not on. One of the things that I've gotten hooked into recently, and my wife got this for me for our anniversary, for my anniversary, was it's called Mind Valley. And I'm not sure if you heard of it, but they actually just dropped the price. It's like $500 a year. And it's almost like business coaching where this gentleman who started it, Vishon, he, if you want to Google it right now, it's pretty cool. He basically is trying to, he's like the Elon Musk of education is the way I look at it. He's wants to get people away from a typical college, go learn specific stuff in a book, and have executives in the real world 20 minutes a day teach a course that will better yourself and get you thinking differently and a little bit outside the box. So he's got some speakers on there who are world renowned at business coaching, raising money, networking, getting the most out of people, especially like athletes, peak performance from that perspective. Public speaking is an example. So, for example, on the podcast, if you want to learn how to, present better, it's things like that. And, I look at it and, it's $500 a year, $40 a month. People spend that on, many other things. And I've been using that now for the last 3 months. And I found that to be, extremely educational. And some of the things that I've learned in the past reinforces that, but also gets you to better understand yourself, because it really starts with understanding yourself to be able to succeed. Because people try and influence you to tell you to do certain things a certain way, but that might not fit for you. So you really gotta learn from inside what it is that makes you tick and go from that perspective. And I found, like I said, that's been kind of a thing I've been following a little bit recently, besides typical stuff online, DS News, Housing Wire, and some of the stuff like that is some of the other sources of articles and stuff that I've read. But it's been interesting too that recently it's just been a completely different world because of the pandemic. So nobody can really predict a lot of things.
Right.
Kind of what's next.
Absolutely. Yeah. Like conferences. I know that the note investing space is it's predicated on building relationships at conferences. And that's exponentially harder virtually. You can't really shake hands and have a drink at the bar or something, right? So that whole aspect is kind of gone. I'm not sure when that's going to come back. When we talk about...
Can I just jump in on that?
Yeah, please.
A lot of people, that's one of the things a lot of people think is a big setback. I have probably been to 2 conferences in person, and which is not a lot because I mean, again, with everything I have going on, I hate traveling. So what I've done in kind of this COVID world has been perfect in one sense. They have these online conferences. I'll reach out to people during or after a conference, say, hey, let's do a Zoom call. Let's just introduce. And, you realize like you can, set people up half hour. Like there's a big conference called imn.org, which has a lot of, it's not more for newer investors. It's for people who've been around. I reached out to probably 200 people to set up calls. Probably 50% responded. So I had probably 100 phone calls since August with people. And during that time, I've gotten 3 new sellers, relationships with sellers. I've got new software leads with other entities. Just ways in just even things that like software, no way I could afford because it's for people who have like 100,000 loans or these major companies. They give you ideas on how to do things at a smaller scale. So it's not only just, trying to build a relationship from that perspective, but it's also seeing how these major companies do things that you might be able to do to better your business.
And you're talking about tech. So we wouldn't be the tech guys who invest if we didn't ask you some type of a tech question. And what would you say is a piece of technology that you feel can make the note investing experience better?
Well, I wish, so here's my wish first, which is that the title process and land record process would go into some type of, I'd say, blockchain, in the sense of, when people think blockchain, you just think Bitcoin, but, blockchain is really a technology of, and I don't know too much about it, but basically it's a process that things have to happen in an order, essentially, and then gets verified. And with recording deeds and so forth and assignments, that is perfectly set for, public records of land records. So that would be awesome if that could ever happen. But I mean, the technology, the thing I'll mention with note investing is it's like project management. So you need a software, each node is like a project because you have to manage a servicer, you have to manage an attorney, you have to manage the taxes, you have to manage, there's the borrower that the servicer has to manage. You have to, there's so many, a realtor, a preservation company. There's a lot of things you have to manage. So, the type of software, is, that fits your need, because I use so many different softwares to try and manage my notes. I was even using a CRM system to manage. And then finally, I got to a scale. So most people, as they start out, will use software called Pipedrive or Podio. Some people have customized those to be for note investing. And those are great for starting out. As you start to scale, I actually went and just started using software that the loan servicers use. It cost a lot of money, but in the same token, I didn't have to bring on any full-time employees. So when you think of an employee cost versus software cost, I look at it from, I'm saving a lot of money, even though it was a $10,000+ investment, from that perspective. So that's a big thing, and just managing, your assets so you stay on top of everything. So
excellent.
And of course, these things.
Mobile phones.
Like I said, you can run this business from anywhere. As long, most of the stuff is run off of email. Email back and forth, a call. Pick up the phone and call. So that's how a lot of it goes. Because I like to think I'm somewhat tech savvy, but at the end of the day, compared to like my kids and stuff like that, no, not anymore.
Yeah. The rapid acceleration of technology is just mind blowing. It's like a major hockey stick, and we're going straight up at this point. Chris, thanks so much for coming on, and thanks for the value you have brought to our listeners. If someone wants to check out your podcast, where can they find it, and where can they find out more about you?
Yep. So they can basically find it on Stitcher, iTunes, Google Play, all, pretty much anywhere. Listen to podcasts. Can go to 7E Investments, the number 7, the letter E, investments.com, as well, or can email me, and that's Chris at 7einvestments.com.
Excellent. Thanks again, Chris.
Thank you.
What's up, TGWI Insiders? We'd like to talk to you about our big goal for 2021 that we're determined to hit, but we need your help to do it. Our goal is to get 250 positive comments and reviews on Apple Podcast. You can help us in less than 1 minute, even as you're listening to this podcast episode. On your phone or computer, you can do this in 3 simple steps. First, search for us on your Apple Podcast app. Second, navigate to our podcast page by clicking our logo. And finally, scroll to the very bottom where it says leave a review to leave us a 5-star review and a positive comment. You can also get these step-by-step instructions by going to tgwipodcast.com/review. It's fast, easy, and would help us a ton. Thank you for your continued support, TGWI Insiders.
That's it for this episode of Tech Guys Who Invest. This is Adam.
This is Kevin. Thank you so much for listening to this week's episode. Be sure to subscribe to the podcast for the latest episode updates and to receive additional investor insights to help you invest wisely and safely. You can join the TGWI Insiders community at tgwipodcast.com/subscribe. Lastly, we would love to connect with you. The best way to reach us is by sending us an email at techguyswhoinvest@gmail.com. Thanks, everybody.